Hi, my name is Sophia Chan Combrink. I'm the Executive Director for the Canadian Chamber of Commerce in Hong Kong, a nonprofit, non-governmental organization that was created in 1977. Today, we have over 1,900 members representing nearly 300 companies. This makes us one of the largest Canadian business organizations outside of Hong Kong and one of the most active international chambers in Hong Kong. For non-Canadians who are listening in, it's important for you to know that we are an inclusive and diverse community. So about 40% of our membership is non-Canadian. Everyone is welcome. What do we do exactly? We deliver 4 services to our members: representation and advocacy engagement, business promotion, networking and brand exposure, learning and training, and of course, information and insight. Today, we'll be hearing from Sonja Chong, and I'm just going to introduce her in a little while. Sorry, I'm having technical problems. She is a very seasoned veteran tax accountant, and I'll let you, I'll hand it over to her first, and then we will resume some more introduction later. I'm sorry about that. I'm having technical problems. Over to you, Sonja.
Okay, thank you, Sophia. Not a problem. We are all learning about this. Hi, everyone. Welcome and good morning to you. I would like to thank the Canadian Chamber of Commerce in Hong Kong for inviting me. Very much, feel very honored to be invited. And today we are going to be focusing on Canadian income tax, and basically Canadian income tax has, I guess, 2 levels. One is levied at the federal level and the other one is at the provincial level. However, except for the province of Quebec, most other provinces have, in terms of individual income taxation, followed the rules of the federal government. So for all intents and purposes, when it comes to income tax, the federal rules are basically the same as for all the provinces. So it's complex, as many of you may know. So today we're just going to go through a general understanding of the income tax system, giving you some guidelines and a few tips and pitfalls. So without further ado, let me share my screen with you. So is everyone able to see the screen, the PowerPoint presentation?
Yes, we are.
Thank you. So we're just going to go right ahead to the second slide. So first and foremost, how does Canada levies income tax? It levies income tax based on residency. It is not based on citizenship, unlike the US system. What is the meaning of residency? We will go through that in a little bit more detail on the second slide, on the third slide. But basically, if you are a Canadian tax resident for Canadian income tax purposes, then more or less your worldwide income would be subject to Canadian tax. And essentially, there are 2 ways that Canada levies tax on individuals, or for that matter of fact, corporations and so on. But today we are focusing on individuals. So most of us know that if you have income in your name, then you would have to include your income on your personal income tax return and report tax on it. However, most people do not know that there could be indirect income that you did not earn, but which you have to report as your personal income as well. So if we look at the first one, directly earned or received. So worldwide income based on residency for income tax purposes, which I submit to you is not necessarily the same as residency status for immigration or citizenship purposes. And worldwide income basically would include, salary, dividend income, interest income, royalty, as well as 50% of capital gains on the sale of your stock investments and other types of investments such as real estate. So right off the bat, you know there's a huge difference between Canadian taxation and Hong Kong in terms of the scope. Because Hong Kong does not levy tax on dividend income, not on interest income. I don't know about royalty income, and definitely not on capital gains. So at this point in time, if you make money on the stock market or selling something which constitute longer term investments, the profit that you make is called capital gains, and 50% of that is to be included, subject to tax. Although there are talks that the upcoming federal budget, normally it comes out in April, so there have been talk that perhaps the capital gains inclusion rate could be increased from 50% to 2/3 or even to 75%. No one knows until it comes out. So one of the questions that people like to ask is, well, okay, worldwide income, and how would CRA know? Basically, it's a voluntary reporting system. Okay, so you have to be diligent, and ignorance of the law is not an excuse, or at least not accepted by the CRA. So it's up to you to report, and if you do not report everything, then you have to be concerned if CRA finds out. And since 2014, Canada entered into a tax treaty with Hong Kong, and it's called income tax. It's called an income tax agreement as opposed to a tax treaty, because Hong Kong is not considered as a country. Now, so that is directly earned income. What about indirectly earned income? So if you, as we all know, the scope is wide and it's worldwide income. So a lot of people would think, okay, why don't I do it this way? If I have, let's say, $1 million of surplus funds, what I could do is I could set up a Hong Kong company. I would subscribe to shares of that Hong Kong company. I'm the owner, but the Hong Kong company resides in Hong Kong. I would find a director who is a Hong Kong tax resident person. So I have my Hong Kong company invest the $1 million and earn, let's say, interest income or dividend income or whatever income that is passive in nature. So that would also include rental income. So I would say, okay, that's great. Then my Hong Kong company does not have to pay Canadian tax. Well, that is not how it works, because CRA, or the Department of Finance, many, many years ago already foresaw this. So what they have done is they have instituted a set of rules that basically said that, you know, that company is going to be considered as your controlled foreign affiliate. If it is considered as your controlled foreign affiliate, then whatever passive income that this company earns is going to be considered as your personal income. So it's going to treat the company as if the Hong Kong company does not exist. So this is something that you need to be careful about, okay? So what is residency? There are essentially two areas in the Income Tax Act that deals with, actually three, but let's say that the main ones are two. So the first one says, if you're ordinarily inhabiting in Canada, then you are considered to be a Canadian tax resident for Canadian income tax purposes. The term ordinarily inhabiting actually is not defined at all. So what does it mean? So what happens is, in general, it looks at whether you have established residential ties with Canada. So many years ago, or even more recently, taxpayers, when they have disputes with Canada Revenue Agency, they might go to the courts and fight it out in the courts, and the judge would look at the facts and come up with a judgment. And when they render their judgment, they would say, well, in deciding, in coming up to with my decision, I look at this factor, that factor, and that factor. So those are residential ties. Over the years, CRA also adopted the factors that are looked upon by the courts. So what is the meaning of residential ties? Again, it is not defined. So it would look at if someone is going to move to another country, or in this case, returning Canadians, i.e., you are Canadian citizens, but you don't live in Canada, but now you are moving back to live in Canada. So what are the things that you normally would do or would have? You would find a place to stay. Doesn't mean that you have to buy a house. You could be renting. You would open up bank accounts. You buy furniture, furnishings. You might have a visa. You apply for a visa from a Canadian bank, or rather, I should say, credit cards. And a lot of times, the people who are closest to you, such as your spouse and your dependent children, would move with you. So these are all the ties that CRA would look at to determine whether you have become a Canadian tax resident again. It also includes things like driver's license, whether you have health coverage in Canada or provincial health coverage in Canada. So there are all these factors, and it's a case of, just to illustrate, let's say if you have met all the factors, then you're at this end. If you're at this end, then you'll be considered as a resident. The less of these things that you have met, then there's less likelihood that you have become a Canadian resident. So that normally happens when is the starting point? The starting point is, let's say that tomorrow you landed in Canada, you will be landing in Canada, your intention is to come back here, you came with your family and so on and so forth, then tomorrow is the day that you became resident. And it is from that day onwards that your worldwide income would be subject to Canadian tax. Now, there's another set of rules that I think a lot of people perhaps have misunderstood, but most people seem not to know about this first rule, ordinarily inhabiting in Canada, which is the overriding rule, by the way. Instead, most people understand about the 183 day. So this is very simple. This set of rules basically looks at your physical presence in Canada. If during a calendar year, it's always on a calendar year basis, if during a calendar year you are physically present in Canada, whether it is in and out or one tranche, as long as you have been here in that calendar year for 183 days or more, then you will be deemed to be resident for the entire year. So, for example, let me see if I can move this chat box away. I cannot, but hopefully you don't see the chat box, that you just see the screen. At the bottom, I have an example. So what I have is January 1st, 2021 to December 31st, 2021. And this particular person, let's say, decided to return to Canada and to live here for the foreseeable future on March 1st, 2021. The person moved to Canada and has established, over this period, has established residential ties with Canada. If that is the case, then the person would be considered as a resident starting from March 1st, 2021, and the worldwide income from this point to this point would be subject to Canadian tax. On the other hand, if it is a sojourner and is deemed to be resident in Canada under this rule, then the person would be deemed to be resident starting from Jan 1st, 2021 to December 31st, 2021 for the entire year. Okay, so one example of a sojourner could be Americans, hockey players, who perhaps would come up to Canada every now and then to compete in tournaments. So, hockey players, for the most part, they are quite wealthy, so they would have their appropriate tax advisor who would be tracking their number of days physically present in Canada. So if it exceeded 182 days, then they will be deemed to be Canadian resident for the entire year, which may not what they want. Fortunately, in this case, there is a tax treaty between Canada and the US, and the tax treaty has this thing called tiebreaker rules that would mediate such that in a situation like this, they will go through a number of factors to see sequentially, to see whether the taxpayer has closer tie to Canada or the US. So the tiebreaker rules basically applies when a person could be considered as dual resident. The tiebreaker rules comes in and determine whether you are one or the other. So similarly, there are tiebreaker rules in the Canada-Hong Kong income tax agreement. Okay, we won't go through this in detail because we have lots of things to cover tonight, or rather this morning for you. There are many types of taxes that can be levied in Canada. I'm just listing it here, and I'm not going to go through it in any great detail. This is just for information. Now, aside from income tax return, there are also information returns that one has to file if you have various types of foreign assets. Okay, so we can take a quick look on the next page. So what are the information returns? Information returns basically are returns that you have to file if you own certain foreign assets, or if you're a beneficiary of an offshore trust and you have received a loan, a distribution of trust income or capital from a non-resident trust. And this one is if you have transferred property to non-resident trust and you are a resident person. So these are rather complicated ones that I'm just listing it here so you become aware. This one here, T1134, has to do with foreign affiliates. Remember the second slide or the first slide? Sorry, the second or the third slide, I talked about indirect taxation. So this has to do with foreign affiliates. Okay, so if you have foreign affiliates, you have to disclose it on form T1134. These forms needs to be filed every year. Just very quickly, what is a foreign affiliate? A foreign affiliate is a foreign company whereby you own 1% or more of the shares. And you and people related to you own 10% or more in total. So if that is the case, then that is a foreign affiliate of yours. When it comes to control foreign affiliates, the rules are simply a lot more complicated and we won't go through it today. But suffice to say that you need to be aware about the existence of control foreign affiliates because it is these companies where their passive income would be treated as your personal income, even though no dividends have been paid to you. Okay. Now, the last one is the most common one, which is T11, form T1134. It's like a catch-all. Like if you don't fit any of this, then all other foreign assets, to the extent that the aggregate cost of these foreign assets has exceeded $100,000 at any point in time during the relevant year, then you have to file that form. It's a pretty long list, and here I've only listed sort of, the more common ones. The balances you have in your foreign bank accounts, GICs, term deposits, foreign real estate, share investments, money owed by non-tax residents to you, because now you are a resident person. Okay, so at this point in time, the only exemption from filing these forms only applies for the first year of first-time individual residents. As you know, the topic, the theme is returning Canadians. So I assume that all of you have already been a Canadian tax resident sometime in the past, and then you move to Hong Kong, and now you may be considering returning to Canada. So this exemption does not apply to you because you are not a first-time individual resident. So let us go on to, again, I am not going to spend much time on this. You have the handout so you can go through it yourself. If you fail to file these information returns, these are the penalties that you may be subject to. Okay, so the next few slides, I just want to share with you the key concepts for returning Canadian residents. I get asked this question a lot. What if I have lived in Hong Kong for the last, I don't know, 20 years? I have made a lot of money. I pay very little tax. I have been, accumulating and reinvesting. So if I were to come back to Canada, what would happen? So let's put some numbers, okay? Let us say that you have accumulated, just for fun, $5 million. So if that $5 million, when you bring it back to Canada, you don't necessarily need to bring it back to Canada in terms of transferring it to a Canadian bank account. It could stay in a Hong Kong bank account. It can stay in a BVI, whatever. That $5 million will be considered as your capital. Okay. Now, I'm assuming that, again, that for the last 20 years, you have not been a Canadian tax resident, that you have been a Hong Kong resident. So in that case, this entire $5 million is your capital. And when you resume tax residency in Canada, you are not going to be having to pay tax on this $5 million. However, if you invest this $5 million, the income earned thereon would be subject to Canadian tax. Like I said, you could leave the $5 million in a Hong Kong bank, earning, just for fun, 10% interest. So your whatever, $500,000 of interest income would be subject to Canadian tax. Or if you prefer to bring the $5 million back to Canada and lodge it with a Canadian located bank, same thing, the income would be subject to tax, but not the capital. Another key concept is deemed acquisitions at the time of resuming residency. So let us step back for a second. Now, as I mentioned at the beginning of this webinar, Canada levies tax based on residency, unlike the US, which is based on citizenship. Actually, it's more than citizenship, but let's just say that, let's just deal with that for now. So if you're a US citizen, doesn't matter where you live in the whole wide world, you would always be subject to US income tax. However, Canada levies tax based on residency, and that is tax residency for Canadian income tax purposes. So how do you determine when it comes to, when you buy and sell properties and so on, how does the rule work? So because of this, Canada has a set of rules that basically said, when you become a Canadian tax resident, we are going to assume that you have bought, deemed purchase, deemed acquisition, that you have bought that asset at that point in time. So if we go down to here, for example, okay, 3 years ago, so from this point to this point, you resided in Hong Kong, you are a Hong Kong tax resident, you were not a Canadian tax resident. So you bought whatever it is, let's say a Hong Kong apartment. I don't know if you can still buy a Hong Kong apartment at $1 million, but 3 years ago, let's say that you bought the Hong Kong apartment at $1 million. Then you decided to return to Canada and become a Canadian tax resident on March 1st, 2021, which is time T. at that point in time, that Hong Kong apartment has increased in value, has doubled to $2 million. That's the fair market value. So for Canadian income tax purposes, you are deemed to have acquired that at 2 million. Okay, so that becomes the cost base of your Hong Kong apartment for Canadian tax purposes. Okay, so now let us, just so that you can see what does this mean. As an example, I would say that you returned to Canada last year and you ended up staying here for 10 years. And after 10 years, you decided, I want to return to Hong Kong. So on March 1st, 2031, you became a non-resident again. So at that point in time, there is another set of rules that would apply. And let's say that at that time, 10 years later, you have kept your Hong Kong apartment, and your Hong Kong apartment now is worth $5 million. So there's another set of rules that comes in, which would assume or deem that you have sold your Hong Kong apartment at $5 million, for $5 million immediately before you became a non-resident. So what does it mean? It means that your cost base is 2 million, your sale price is deemed to be 5 million, and you have a capital gain of 3 million. So that is how it works, is that Canada levies tax on the increase in the value of what you have during the period of residency. Okay. Now, there are some exceptions. If I had used Hong Kong apartment, but if that had been a Canadian apartment, like perhaps you bought it 3 years ago and you have rented it out all this time. Now, then you resume residency in Canada on March 1st, 2021. Now, the deemed acquisition rule does not apply because that's one of the exceptions. Why doesn't it apply? It doesn't apply because Canada always reserves the right to levy tax from day one if it has to do with Canadian real estate. Basically, anything that is on Canada's land, Canada reserves the right, and therefore it does not need this deemed acquisition rule and then deemed disposition rule to apply when it comes to Canadian real estate. Okay, there are other exceptions as well, which we are not going to go through. So at this point in time, I just like to add one thing. Which is not on the slide. That in terms of this deemed sale at fair market value, if you decide to return, if you decide to stop being a Canadian resident, in this example, 10 years later. Now, if during these 10 years, sorry, I'm going to change the facts a little bit, okay? So you became a Canadian resident and you came back here to live until, let's say, March 1st, 2025. That is 4 years, 4 years from 2021. 4 years later, you felt, well, gee, I thought I would really enjoy the life in Canada again, but actually I don't. Or maybe your personal circumstances or your family circumstances have changed and you have decided to return. So we have now brought forward, right, the becoming non-resident date from March 1st, 2031 to March 1st, 2025. So you have basically lived in Canada for less than 60 months. Okay, so if that is the case, this deemed sale rule actually does not apply to whatever that you have brought in at the time that you became resident back on March 1st, 2021. In addition, in these 4 years, if you have received inheritances, okay, and they have, you know, gone up in value, whatever, again, this deemed sale at fair market value rule, when you became non-resident, also does not apply. So I think we need to move on to the next one. Okay, so I just want to, I have a few examples here, some of which I actually have gone through just now, but just to illustrate. So the previous slide, we dealt with you becoming resident again, and then 10 years later, decided to leave Canada. And another example that I said was that you decided to leave 4 years later. Now, this one is slightly different. We have Hong Kong apartment that you purchased on February 8th, 2012 for $1 million purchase price. You resume residency in Canada 10 years later. I just pick a number. By then, the property has gone up to $4 million. As I said, you are deemed to acquire the Hong Kong apartment at the fair market value when you became a tax resident again. Therefore, your cost base, adjusted cost base, is now 4 million, exactly the same as your fair market value. So you have returned to Canada, and again, this example assumes that you have kept your Hong Kong apartment, and then you sold it 6 years later for $6 million. The gain that you have to report to the Canadian government and pay tax thereon is 2 million, being 6 minus 4. Okay, and according to the current rules, you have to include 1 million, which is called taxable capital gains, into your income tax returns. The next one has to do with Canadian real property. I have alluded to it, but I thought that I'll give you some numbers so that you would be able to retain it a little bit better. Again, we have the same numbers. You purchased it while you were in Hong Kong, February 8th, 2012 for $1 million. You resume residency February 8th, 2022, 10 years later. The fair market value was 4 million. And 6 years later, you sold it for 6 million. So I guess that is the thing with virtual, with webinars. Normally, if I run a physical webinar, a physical seminar, I would be asking this and somebody would be replying. So in this case, when you sell, do you think that the cost base is 1 million or 4 million? So I guess I have to answer my own question. The deemed acquisition at fair market value rule at this point in time does not apply to Canadian real estate. It does not apply to Canadian real estate. Thus, when you sell it in 2028 for 6 million, the amount of gains that will be subject to Canadian tax is 6 minus 1, which is 5 million. And under the current rules, 2.5 should be included on your tax return. Shareholding. What if you have always run a very successful business in Hong Kong using a Hong Kong company, and you had set this company up way back when, and you just subscribe to $1 of the shares of this Hong Kong company? I mean, of course, chances are you'll be loaning a sum of money to the company for it to run at the beginning. And then it ran for 10 years, very successful, and you decided to return to Canada as a tax resident. However, the company, the business run by the company, really doesn't need your attention anymore. You can simply just have somebody else do it for you, look after it for you. Now, in this case, the shares of the Hong Kong company, you would be deemed to acquire the shares at the fair market value in 2022 of 5 million. So the adjusted cost base is 5 million, okay? Now, when you were here, like I said, you ran a very successful business through this Hong Kong company. You have taken perhaps salary, you have perhaps taken dividend income, dividends, fan hong, right, in Hong Kong. And, salary, yes, you have to pay tax, Hong Kong tax on that, but you never had to pay tax on dividends in Hong Kong. However, it would be different once you have become a Canadian tax resident. If you start to take dividends from the Hong Kong company, it will be subject to Canadian tax. So the next one, I hope to be able to quickly go through this, is a planning strategy that you could consider. So as I said, based on the previous slide, in this case, I call the person Miss Ho. So she's the one who set up Hong Kong Co, ran an active business. The key is this is an active business, and it's a defined term in the Income Tax Act. The Hong Kong company would be considered as a foreign affiliate of Miss Ho, as well as a controlled foreign affiliate of Miss Ho, because she owns 100% of the common shares. So Miss Ho set this up a long time ago. Then she resumed residency in Canada, which is why I have her up here. This is the borderline. Above is Canada, below is Hong Kong. So if Hong Kong Co, so Hong Kong Co, makes whatever it makes, pays, what is it? At most, 16% tax or 16.5% tax. Then the remainder, if it is distributed to Miss Ho, she would have to pay tax on this amount. Okay. Now you might want to consider. Now I'm just going through this with you in general, so that you know that there's planning that can be done. There are other types of planning as well, for various purposes. So in this case, it may be that Miss Ho would want to, at some point in time, sell her common shares in the Hong Kong company to a new company, a Canadian company that she has set up. So then she sells it to the Hong Kong company and takes back shares. Okay, so takes back shares of the Canadian company, and that is permissible under Section 85(1) of the Income Tax Act. Now, we said that the Hong Kong company shares have gone up in value. So first of all, the cost base is 5 million. So the cost base is 5 million, which is great. Now, it is a tax-free, but even if there is an increase in the value from the 5 million later, because this doesn't need to be done right at the point of resuming residency or before resuming residency, it could be done later on as well. So presumably or conceivably, Hong Kong Co's value could have gone up further from the 5 million, but we can take care of it using Section 85. We can have it transferred to CanCo on a tax-free basis. But what does it mean? Then we make use of the Hong Kong-Canada tax treaty, whereby if this company is carrying on an active business in Hong Kong, it pays the Hong Kong tax, whatever it might be, a very low rate of tax, and distribute dividends to CanCo. Under the Hong Kong-Canada tax treaty, CanCo can receive these dividends from Hong Kong Co completely free of tax, free of Canadian tax. Okay, so this is one way of repatriating funds from Hong Kong to Canada. Now, obviously, from CanCo to Miss Ho, if there's a distribution of dividends, there would be taxes. And there's another way to sort of get around this, but I just want to illustrate to you that all is not lost. Okay. How much time do we have? Let's see.
Sonja, sorry to interrupt. We only have about 15 minutes left of the actual webinar. I'm not sure if you want to just sum up quickly and move on to Q&A. Just feel free to let us know how you'd like to proceed.
Okay, I'll just spend 2 minutes on this one and 2 minutes on the next one, if that's okay.
Sure, no problem.
So I understand that, of those who might be considering returning to Canada, that a lot of you guys may have mandatory provident funds, and you're not sure what to do with it. the long and short of it is actually there are people who have written to CRA a few years back asking about this question. They didn't say mandatory provident funds, but I think it is the same thing. That was back in 2014. So basically, the mandatory provident funds should qualify as superannuation or pension plan under the Canadian Tax Act. And as such, it is taxable in Canada. So if you receive it after you have become a Canadian tax resident, you have to pay tax on it. So you have to include it in your income. And unfortunately, the Canada-Hong Kong tax treaty does not provide any relief. However, the good thing is if you were to withdraw it on a lump sum basis as opposed to periodic, okay, then what happens is if you withdraw it on a lump sum basis, then you have to include the entire amount as income. However, if you were to arrange with the appropriate financial institutions to have it transferred, to have the assets or funds that are in the MPF directly transferred to a registered retirement savings plan, then you can get a deduction under Section 60J of the Income Tax Act, and that would completely offset the income inclusion. However, you have to be very careful that, you know, whatever assets that is within the MPF may not be considered as qualified investments for RSP. So in the event that you are interested in doing something like this, you need to go through it. You need to find the right financial institution, you know, like one or more of the Canadian banks that are in Hong Kong. So you can, you know, discuss with them as to whether whatever you have are qualified investments, which means that you would be able to transfer it to the RSP and get a deduction. So RSP matures in the year that you turn 71. Matures means you have to include everything in your income, the fair market value of everything in your RSP. However, you can transfer it, you can roll it over to a RIF. All it means is that that the entire amount would not be considered as income. Instead, the income will be brought, the amount will be brought into income based on a formula. It could be, you know, like 5% in one year and 3% in another year. It's a whole complicated formula that you could actually go online and Google and you would get that. So now, bearing in mind that if you do a lump sum withdrawal of the MFP, first of all, you include it in your income. If you transfer it to an RSP, you do get a deduction. So it offsets itself, right? It offsets. However, bearing in mind that one day, although it's deferred on the deferred basis, you do have to pay tax on it, okay? So it all depends on what you have, you know, your age, so on and so forth. So perhaps you want to think about withdrawing your MFP before resuming Canadian residency. Lastly, I just want to go through this offshore trust with you, which is something which is very, very advantageous, of significant benefits. For those of you who are lucky enough to have parents, grandparents, perhaps brothers, sisters who are wealthy and would like to, you know, give you either during their lifetime or after they have passed significant amounts, and which you do not need to spend all of it all at once, you meaning you have resumed Canadian residency, then this can be considered. So in this case, grandmother could gift $10 million to a trust, which is set up in a non-resident country and a low tax jurisdiction. The trustee has to be resident in a low tax jurisdiction as well. And the beneficiaries could include Canadian resident children and grandchildren. So the $10 million gifted can be invested. So let us say that, again, using just roughly 10%. So the first year of income would be $1 million. So let's say there's $1 million of income in the year 2022. Comes January 1st, 2023, that $1 million of income would become trust capital. The 10 million is trust capital. Now the trust capital is going to be increased to $11 million. And the beneficiaries might say, the Canadian resident children and grandchildren might say, oh, gee, can I have $500,000? I want to buy whatever, a garage in Toronto or Vancouver. I mean, what's the point of knowing that you could have all this money, but you can't spend it, right? So the $500,000, let's say, can be distributed out of the trust capital of $11 million, completely free of tax. So you can imagine the advantage this could give to you.
What are the current rules for split income, one spouse in Hong Kong and other spouse moving to Canada and earning in Canada?
That question covers a lot of ground. So
maybe that one they should contact you directly.
Yeah, that covers, because you really have to deal with, you know, can a couple claim that one is a tax resident of Canada and the other is not?
No problem. Okay. The next one is there any tax implication for the directly held taxable Canadian property in Canada if you are returning to Canada after 5 years and the value of the house has increased as a non-resident status?
Can you repeat that one slowly?
Is there any tax implication for the directly held taxable Canadian property in Canada if you're returning to Canada after 5 years and the value of the house has increased as a non-resident status?
You're talking about taxable Canadian property, which there are many different types of taxable Canadian property. I'm going to go with Canadian real estate. So the question is, you have Canadian real estate and then you return to Canada, and after 5 years, what happens?
The value of the house has increased and you're still a non-resident.
Oh, and you're still a non-resident. Okay, so you have never resumed residency. Okay, I got it. So if you own Canadian real estate, then, you know, and you have remained a non-resident, it doesn't matter after how many years. If you sell the Canadian real estate, you have to pay tax on it. Because, as I said earlier on, Canada reserves the right to tax anything that is basically attached to the ground. So there is really not much of a relief, except, yeah, no, if you're a non-resident, there isn't much of any relief at all.
Okay, we'll move on to the next question. I won't be able to do them all, but I will be I will be moving back to Canada to take up employment. I own my property here in Hong Kong. Ideally, I would like to keep this property and rent it out to supplement my income in Canada. What are the Canadian tax implications of this scenario?
Okay, so first and foremost, when the person returns to Canada and assume employment, I'm going to assume that he or she has become a resident. So the Hong Kong property, I'm just going to say he, okay? So he's going to be deemed to have acquired the Hong Kong property at the fair market value, okay? Not at the original cost, but at the fair market value. And the rental income, so I'm going to assume that it's a condo, okay? So, and I'm going to assume that it is, again, $5 million, just for fun, the fair market value. So if I'm going to be more aggressive, I'm going to treat the entire $5 million as what we call depreciable property. So first of all, the rental income would have to be included as income. However, you can deduct a whole bunch of things like rates, which is like your property tax, right? Rates and all kinds of expenses, which I realize is not the same as Hong Kong. But but you don't have to follow the Hong Kong rules. You follow the Canadian rules. So you can deduct all kinds of expenses, and on top of that, you can deduct what we call capital cost allowance, which is a tax term for depreciation. And the depreciation is based on a percentage. So for the first year is 2% of the cost, which, as I said, is 5 million, right? So you can have a lot of deductions. I hope I have answered the question.
I can't vouch for you on that one. Maybe we'll do 2 more questions and then we'll wrap it up.
Okay.
One question would be, would there be any tax or insurance policies with saving and investment elements in Hong Kong, such as a whole life insurance policy?
Can you repeat that?
Would there be any tax on insurance policies with saving and investment elements that they're holding in Hong Kong, such as a whole life insurance policy? So I think that they're holding tax insurance policies that have gains and investment elements in them. And when they return back to Canada, what happens on those gains earned on the insurance policy?
I haven't dealt with a situation like this. Based on my general understanding and knowledge, there should not be tax on the income that have accrued thus far in the plan. Thereafter, you have to look at the insurance policy and see if it qualifies. If it qualifies under the Canadian insurance under the Canadian income tax rules for insurance policies, particularly foreign insurance policies.
Okay. The last question, I think, is any tax affected if you are above 70 years of age?
How do you mean?
If you're older than 70 years, is there any tax benefits of being elderly, considered elderly?
I suppose there are. There is old age security that you could get. There's old age security, which is, but if you have other sources of income, once your other sources of income reaches a certain level, the old age security that the government gives you would be clawed back. Yeah, so that's what it is. It's hard for me to comment if I do not know, the other situations, because if you're talking about someone who does not have any other sources of income and who basically just returned to Canada, then basically you're just looking at old age security, I think, and you have to meet all the rules, right, to qualify, because I think you have to be in Canada for how many years and so on and so forth. So other than that, I don't know. There are lots more other benefits that you would get.
I think it's clear that you definitely know, you're very experienced in this subject matter, but I think a lot of the tax questions that have come in are quite complicated and quite personal as well. So but thank you very much. I'll ask Sophia to come back on to wrap up this session.
Thanks, Sonja, for that comprehensive discussion that sets us in the right direction for those of us who are thinking of returning back to Canada at some point. And thanks to our Sonja for moderating and presenting the questions. For those in attendance today who are part of the wider Chamber community, but not yet members of the Chamber, we do invite you to consider being a member to grow your own business and personal networks. So important now during these challenging times. So you'll see in your chat box, for those of you who are alumni of Canadian universities, you can try us out. by becoming an affiliate member for free. And the link will be seen in the chat box below. So we hold up to 80 events a year. And as an affiliate member, you can access members' rates to events. However, other benefits and memberships do not apply. I think that's it for me. I'd like to thank everybody again. I'd like to thank Sonja Chong again. It's quite late, and I hope you have a nice dinner afterwards. She's in Canada. If you'd like to get in touch with her, please feel free to connect with her. I think she gave you her deck, and her information is there. A big thank you to you, our audience, and I hope you found today's webinar valuable, and stay safe, and please take care of each other. Have a good weekend.
Thank you. Take care, everyone.
Thanks, Sonja.
Bye.